Please note this is not a solicitation to buy or sell any securities. Such an offering can only be made by a private placement memorandum, which includes risks associated with any type of investment.
Well, folks, thanks again for taking the time to join our call today. We do always appreciate you joining, attending, and learning more about ForSprings, about our platform, and our 1031 exchange offerings. My name is Lee Iredell. I'm the product manager here at ForSprings 1031 Exchange. And today's call is a special edition presentation. On this call today, we're going to be discussing underwriting Delaware Statutory Trust Offerings, or DSTs as they're more commonly known, in this current market. And specifically today, we're going to take the perspective of the third-party due diligence provider. The current velocity of DST offerings, selling out, new programs coming to market, it's really reached record levels. And so the intense demand for replacement property options in the form of DSTs has really been creating a lot of pressure within RIA and broker-dealer due diligence departments. This year, the industry is on track to reach a record, estimating about $5.2 billion in DST equity that we expect will be raised at the current pace, and that's as of April 15th. And the average time for DST offerings in the market has been running about 75 days. But I can tell you, and I'm sure some of you on this call will agree, it really doesn't seem like the DSTs are on the market even that long, especially the higher quality credit deals. The workload, the urgency associated with reviewing new offerings has really increased significantly, to say the least. And yet, our point today on this call is that thoroughness and accuracy still need to be maintained in the diligence process, even under such intense pressure to approve offerings and to do so quickly. So, joining me on the call today is Brandon Raatikka. Brandon is the Chief Operating Officer and Principal at FactRight. FactRight is a third-party due diligence firm. It's one of several third-party due diligence firms that we work with here at ForSprings 1031 Exchange. Sponsors like us, we typically engage firms like FactRight to provide reports on our companies and also on our DST offerings, and that you can reference in your own due diligence process. You can use them as an augment to the risk evaluation that you're conducting when you're considering which programs are likely to provide the best outcomes for investors. So Brandon will share some of the methods of evaluating risk in DST offerings that may cross your desk. He's also going to provide some actionable tips for how to best position yourself to effectively and efficiently, which is a really key point to make, to effectively and efficiently underwrite DSTs. He'll be sharing his thoughts from the third-party perspective because day in and day out, that's what they do. We always try to keep our calls to about 30 minutes. I think we might run a little bit longer. We want to make sure we address your questions. So I'm going to ask if you wouldn't mind, with a large group on today, if you would like to have a question answered, we'll definitely take care of that. But feel free to type those questions in right away into the chat window. I put a message on the right side of the screen. You should see that there. And if you wouldn't mind, get those in early so I can gather them up. We're also recording today's call for archiving purposes. Before we get started with any webinar, we always have to cover risks. So it's important to note there are risks associated with real estate investing and investing in offerings of syndicated commercial real estate programs, which are discussed as part of this presentation. Also, the continued spread of the COVID-19 virus globally has created significant uncertainty and risks to investment offerings. They could have a negative impact on the programs, on their valuations, and of course on the macro environment as a whole. The information contained in the presentation is solely for informational purposes. It doesn't purport to contain all the relevant information necessary to make an informed investment decision. Some of the statements we make in the presentation are forward-looking in nature, and investors should consider all risks and uncertainties described in the confidential private placement memoranda for each of our offerings. And finally, we are discussing 1031 exchanges, tax-deferred exchanges, so investors should consult with their own tax advisor regarding any investments in programs offered by ForSprings 1031 Exchange and the qualification of such transactions under Section 1031 for the investor's specific circumstances. So most of you on the call today, are probably familiar with us here. I'll be brief. Our company, ForSprings Capital Trust, was formed in 2012. We're structured as an internally managed private real estate investment trust. And in 2014, our company formed Foresprings 1031 Exchange, a platform that offers Delaware Statutory Trust and other types of 1031 exchange programs to our selling group and individuals seeking exchange replacement property opportunities. Over the past 7 years, we've developed a syndication model for our DST offerings that provides an alignment of interests between the sponsor and our investors. That's done through co-investment by our sponsor of between 5 and 25% of each DST offering. We also provide certainty of closing since we own the DST properties before we ever admit investors. And we are able to leverage the balance sheet of our portfolio, which is now over $600 million, I think it's closer to $670 million, of net lease real estate properties. We're growing the 1031 platform, and we now have the array of solutions you see on the slide. But we're not going to drill down on any of those today. We'd be happy to discuss them with you at any time. And we typically offer a regular webinar that talks about our platform and updates to our platform. So as I get ready to pass the mic over, and Brandon, I promise to do that, give myself a hook here in just a second, it's important to take just a second to mention some of the primary reasons why these Delaware Statutory Trust offerings have become the preferred structure for many 1031 exchange investors. So by the time a real estate investor has decided to go the route of a DST, they've elected to take a passive path, a passive management path, to get away from the day-to-day management of properties and to move to a process where they're invested with a group of professional managers and they can simply collect a check each month. So perhaps the most important factor we see today, and maybe Brandon will be able to underline this as well, is investors for DST programs are looking for certainty of close. There's so much competition for properties right now. Markets are competitive. And in this environment, there's so many factors that can contribute to an interruption to the process of finding replacement property and closing in the required time frame. DSTs can also fill in the gaps. It can ensure that there's a complete tax deferral. Minimum investments they're low, rather low. $100,000 is the typical starting point. And there's no loan guarantee. The borrower for the DST programs is the actual DST entity versus the individual investors. And finally, from a diversification and I would say a barriers to entry standpoint, with smaller investment requirements of DSTs, exchange investors have an opportunity to assemble portfolios of quality, very high quality replacement properties, exchanging up, so to speak, with their proceeds, and they can do that with smaller dollar amounts, which they otherwise would not be able to do. So with all this as a backdrop, I'm going to now give myself that hook, and it's now my pleasure to pass the floor over to our guest presenter, Brandon Raatikka. Brandon is a member of the State Bar of Minnesota, and he serves as Chief Operating Officer and Principal at FactRight. Brandon, I just want to thank you on behalf of everybody on the call today for making yourself available to present, and I'll make sure I change the controls over here so you can walk us through the discussion. The controls are now yours.
Great. Hey, thank you, Lee, for inviting me today and teeing up the discussion. I don't think I've ever had such an extensive risk disclosure disclaimer read before anything I've said before, but I think I'll try that at home with my wife and see how that works. Well, good afternoon, everyone. I hope you are well. I'm glad to be joining you today. Our firm, FactRight, evaluates a lot of DST programs on behalf of broker-dealers and RIAs. We've reviewed more than 60 DST programs since the beginning of 2020. And so my ultimate goal over the next few minutes is to draw out from this experience some practical wisdom that you can apply, hopefully to improve the effectiveness of your own due diligence at a time when that's never been more critical, as Lee has said. Our mandate as a third-party firm is to identify the material factors that are most likely to stand in the way of investment objectives, and then evaluate those from a risk-return standpoint and help our clients make sound investment decisions. And because there are a lot of due diligence rabbit holes one could potentially go down, I think it's beneficial to have top of mind the program's investment objectives because they are going to help keep you focused on what's important. So the typical simplified objectives for a DST program is on this slide. And these are tax deferral under Section 1031, usually, current income, usually, although not always, capital preservation, and then sometimes there is a subsequent investment opportunity, and we'll talk a little bit more about that towards the end of our discussion. But the objectives provide, perhaps an intuitive, straightforward, but nonetheless elegant framework for evaluating deals. I believe it helps us to put risks into context so that you can answer the ultimate question, which is, are the anticipated or probable returns worth the risk that your client will take on? It's also critical to appreciate that there is a related level of risk, which is for you as the advisor. As in any line of wealth management business, there are legal and regulatory risks for you, especially if your client has a bad investment outcome. And legal and regulatory challenges often center around the adequacy of the advisor's due diligence. So I'm hopeful that what I'll share with you can help mitigate these risks for you as well as your client. I'll spend some time on how we as a third-party due diligence firm evaluate DST sponsors and their program structures. Then I'll talk a little bit about how to look at the underlying real estate, its market, and the economics of the investment. And then I will conclude with some concrete steps you can take to put your best foot forward from a due diligence perspective in light of today's mad scramble to place clients into DST programs. And then, as Lee said, we'll save a few minutes at the end for questions and answers. And it probably goes without saying that what follows is not an implicit endorsement or recommendation of ForceSpring products. Every DST we review has risks, and you can see how we assess ForceSpring's offerings specifically, as well as other DST programs, in our due diligence reports, which are available to broker-dealer and registered investment advisor home office personnel on FactRightReportCenter.com. At that site, you can access all of our current third-party due diligence reports free on demand. All right, so let's turn to how we evaluate sponsors, structures, and properties. So in my opinion, the number one consideration for any alternative investment decision is who you and your clients will be doing business with. After all, the sponsor is going to be responsible for achieving the investment objectives we just talked about. We devote entire due diligence engagements to the sponsor, their leadership, operational capabilities, capitalization, and track record. And we ask questions like, what is their real estate acumen? Do they have experience in different market cycles? This is especially important now in light of the relative uncertainty surrounding commercial real estate. Returns, how have they achieved them for their investors? Have they done what they have said that they were going to do? Who are the vendors they work with? What is their reputation? A big one in the DST context is Securities and Tax Counsel, which is obviously very important from a tax deferral standpoint. But who's the managing broker-dealer that they use, and other operational vendors? What is the sponsor's financial position? Do they have the resources and revenue to stick around during the hold period in order to service your clients? I think one of the most underrated considerations here is how proactively the sponsor has dealt with problems in the past, and in particular, how well the sponsor communicates about these problems to their investors. I can think of one sponsor in particular which syndicated several 1031 tenant and common programs right before and concurrently with the Great Recession. Not surprisingly, many of these programs ran into problems, but the sponsor and the broker-dealers that placed clients into these programs avoided litigation, I think in large part because the sponsor worked so hard to ensure the best outcomes for their investors, and especially they were good at consistently communicating with their investors. So we think that investor relations is a critical function. And then speaking of legal and regulatory issues, we recommend that you either run background checks on key sponsor executives and entities or consult background checks that are found in third-party due diligence reports. And then with the sponsor, you also have to understand how they structure their DST offerings, because every sponsor does it a little differently. And there are several various layers of structures to pay attention to. Obviously, you have the overarching structure of the Delaware Statutory Trust, which is, honestly a relatively inflexible structure for ownership of real estate, but it's used to obtain the tax deferral objective because that's what the IRS requires. There are several significant restrictions on actions that the trustees can take on behalf of investors relative to the property. So thus, the governance structure is fairly standard across DST programs. Although we still do see some subtle differences in the various trust agreements that we review. For instance, as it relates to transparency, sometimes there are restrictions on investors' ability to review books and records. We see different standards for the type of financial statements and reporting that the trustees must provide to investors. Another layer of the deal structure is the master lease, which isn't present in all DSTs we review, but a fair number of them. Even though the IRS revenue ruling that blessed the DST wrapper's use for 1031 does limit how master leases can be structured, it is true that master lease structure of sponsor X can share the risks and return economics of similar properties differently than sponsor Y's master lease. And I'm not really going to get much into this today because most of I think the more interesting and important considerations around master leases relate to their use with operational or management intensive asset classes like multifamily and self-storage, where there's going to be a lot of cash flow variability throughout the whole period. And I know that Forest Springs would appreciate it if I didn't spend too much time on asset classes that they don't focus on. But looking at master leases in the net lease context, we compare the length of the master lease to the underlying leases to determine the tenant default or the re-leasing risk the master tenant may be taking on through its obligation to pay rent to the trust and the master lease. And this might be based on renewal assumptions or uninterrupted occupancy during the projected hold period. The last layer of sponsor deal structure I'll briefly touch on is the fee structure. So we evaluate the upfront load ratios and compensation to the sponsor, which is going to impact the likelihood of full capital preservation because the property is going to have to, make up the load during the time that the trust owns the property. And then obviously we have ongoing fees, which for the most part remain pretty consistent from offering to offering of a particular sponsor and are going to have an impact on the amount of current cash flow available for distribution to investors. And when evaluating fees, you have to contextualize them in several ways. So we can compare, for instance, the acquisition fees and property management fees charged in every program in our extensive DST database and develop typical ranges and averages for each fee, and then use that to compare to the property or the DST program under review. And benchmarking like this is great, but we can't just look at fee data points in isolation. Several years ago, we saw a well-known sponsor reduce upfront fees, which is great from a load perspective, but at the same time, it raised its ongoing fees. And, that might improve, capital preservation prospects, but reduce current income to investors. So it might be a reasonable trade-off, it might not be. So you really have to look at fees globally. And then next, you have to determine what the best fee and expense comparisons are. Some items like upfront offering expenses can be compared across all DST programs. Others, like the property management fee, are asset specific. So we would expect management fees on long-term triple net lease assets to be lower than for, say, self-storage properties, given the difference in management complexity and effort required. All right, let's turn to property level considerations, and we'll start with how we assess the property market. Even here, our underwriting of the sponsor is relevant. We ask, does it have the experience and or the strategic relationships in the property market? And we pay as much attention to the neighborhood and submarket dynamics as we do at the metropolitan level, area level, because there really should be good investment opportunities in every MSA. We obtain demographic data for each property location from third-party source, S&P Global, and we do this to determine whether the area trends support the underlying thesis of the real estate. So for instance, we like to see healthy population and household formation growth projected within, the 1 to 5 mile radii for multifamily properties. But we also have to look at, what the development pipeline is for that area as well, to determine whether competitive supply is going to be coming online. And we often consult reports from real estate research firms like Reis or CoStar that lay out analyst expectations for market and submarket vacancy, rent growth rates, et cetera. And then we leverage these to evaluate the reasonableness of assumptions in the sponsor's model. For net lease assets like the kind that Forest Springs syndicates for its DST programs, you still have significant market considerations, even if the program's success is primarily being driven by the tenant's continued performance under the lease. So we have to ask questions like, how critical is the market and the location within the market to the tenant? For tenant leases that may be coming up for renewal soon, understand where market rents may be relative to the renewal rates. We recently reviewed a DST syndication of an industrial property in the Midwest that was located in a very desirable location. So obviously desirable, in fact, that there was a spate of speculative development that began to cause rent growth in the area to soften. And the underlying lease itself provided for relatively robust annual escalations in rent, which, sounds great and, contributes to current investor returns if the tenant continues to perform. However, returns in the value of the property itself may be subject to a material adjustment at a renewal, which in this case happened to be near the end of the trust's projected hold period when the loan matured. Especially if this renewal is based on market rent rates at the time. This is a good segue to talk about the due diligence we do on tenants and leases. There's a lot to say here, so I'll try to be brief. But the two general things we care about most here are continued performance and continued presence of the tenant at the property, which relate to the current income and preservation of capital objectives. So the first question really is, who really is the tenant or guarantor? And believe it or not, this is surprisingly easy to get wrong. So AT&T Inc. has investment grade rated credit by S&P and Moody's. Digital PCS Arizona LLC, which operates an AT&T wireless store franchise at the retail DST property that you might be looking at, does not have that kind of credit. And AT&T Inc. is not guaranteeing the lease at the property. So you really have to pay close attention to who really is backing the lease by actually confirming the legal name of the entity in the lease agreement and or the guarantee. So you can assess that entity's ability to perform under the lease. And we've come across a few instances recently where PTMs have inaccurately represented who the legal tenant is. When reviewing the lease agreement itself, we search for any early termination options the tenant might have, as well as renewal options. We care about the continuity of the income stream during the trust ownership, but just as importantly, we consider the projected remaining lease term at the end of the hold period, because its length will, in large part, determine how a future buyer will underwrite the purchase price of the property. Lease default or non-renewal is always a risk. We try to identify mitigating factors that increase the likelihood that the tenant will remain at the property during the trust hold period and beyond. So we look at things like how long has the trust already been at the property, how strong are its sales if this is a retail property, how much of its own capital has it invested to adapt the property for its own specialized use. And then we evaluate what happens if the tenant defaults under the lease or doesn't renew during the hold period. Does this cause an automatic default under the loan? How easily can the space be reconfigured for a new tenant? What are the market prospects for releasing if the tenant goes dark? And are trust reserves sufficiently capitalized to provide for necessary tenant improvements and leasing conditions. I'll say a bit about the kind of things we look for in our review of third-party property reports that are ordinarily made available by the sponsor. Phase 1 environmental site assessments and other environmental reports are among the most critical. We are reviewing these to identify any recognized environmental conditions or RECs or any other, environmental concern. And phase 1 assessments are especially important because obtaining these can qualify as what's known as all appropriate inquiry under federal environmental law, so that a property owner may use the innocent landowner defense against any potential federal environmental liability that arises in the future. And there are two keys to this that are a common trap for the unwary DST offerings that we review. First, these phase 1s must be obtained within 180 days of acquisition to qualify as all appropriate inquiry. I mean, we've definitely seen more than a few offerings that have stale phase 1s that are supported by stale phase 1s. Second, we confirm that the trust has the explicit ability to rely on the phase 1 report, as this is not always the case. Oftentimes, or most often, the phase 1 is prepared for the lender. Language specifying who can rely on the report is usually near the beginning of the report. Otherwise, we see often sponsors will get a reliance letter in the trust name directly from the environmental engineer. And then we want to see that the sponsor is following any recommendations that the phase 1 makes. Sometimes the engineer recommends that the property owner undertakes a phase 2 limited subsurface investigation to determine whether there's been any soil or groundwater contamination. Otherwise, we review environmental indemnity agreements, no action or regulatory closure letters, or environmental insurance policies to see how the trust has mitigated or is mitigating the environmental related risk. Turning to property condition reports, or PCRs as we call them, PCRs are the most comprehensive evaluation of the major building systems and components ordinarily available for due diligence. We pay attention to the PCR engineer's assessment of the remaining useful life of the property improvements overall. The PCR will note any critical immediate repair items and provides an estimate of capital needs over the hold period. And in the net lease context, you have to understand whether the lease makes the tenant or the trust responsible for anticipated capital expenses. And then you need to compare the trust estimated capital expenditures to available trust reserve funds to evaluate their probable sufficiency for adequate property maintenance. Last, I'll touch on what my favorite third-party report is, the appraisal. Usually this is prepared for the lender. The trust isn't entitled to rely on it, but it's still a very good source document in a lot of ways. Critical uses of the appraisal include things like substantiating the trust purchase price to make sure that it is reasonable and supported by a third-party expert valuation, which is essentially or especially critical to ensure if the trust is purchasing the property from an affiliate. The level of discount the trust may be acquiring the property at relative to fair market value. We are particularly sensitive to this in light of today's market conditions, given cap rate compression in several real estate sectors, including net lease. And the fact that the trust will primarily have to overcome the load through property appreciation. And then last, the appraiser typically has some good information and commentary on market fundamentals, sales and rent comps, and the local area. And we use these as reference points to compare to the sponsor's own underwriting assumptions, again, to assess how reasonable they are. So these third-party reports help to comprise the typical due diligence package provided by the sponsor. But we also encourage, wherever possible, to participate in your own independent physical property visit. a very important part of our own due diligence process is to engage a commercial real estate professional who resides in the local area to physically inspect the property. And we have the site inspection report as an exhibit to our third-party report on the offering itself. This serves many functions. First of all, the inspector can confirm sponsor representations about the property and its location. The inspector will comment on the property's condition and note any deferred maintenance. The inspector is able to speak with on-site management, confirm occupancy, and then take pictures for review. And the scope of our inspection also includes local broker interviews to corroborate what we've read about market fundamentals and insights in the appraisal and offering documentation. And we often find that this kind of on-the-ground intelligence provides a lot of really good color that we use for our overall assessment of the property. I recall for one site inspection for a DST deal we did several years ago, a broker noted that retailers in the area sought after locations that were on the other side of Interstate 65 from where this particular property was. And that was not the kind of insight we found in the appraisal for that property. So before I turn to our top due diligence tips, I'll say a few words about the financial projections that the PPM includes. Of course, projections should be taken with a fair amount of salt because they are projections, which are educated guesses on property performance. But conceptually, they should lay out how the deal works, especially if the master lease structure has some complexity to it. So we think it's worth taking the time to understand them. We review projections primarily for two things. One is to evaluate the reasonableness of the key assumptions upon which the projected returns are based, and two, to see how the deal would perform under different sensitivity scenarios. And we look at several key metrics, but among the most important are the NOI growth embedded in the model to see if, that is an aggressive assumption or a conservative assumption, and then also the terminal cap rate at which the property must be sold to generate enough net proceeds to fully return investor capital at sale. And obviously we have to make some assumptions around the selling conditions there in our own modeling. All right, so we'll spend the last few minutes prior to Q&A reviewing some top due diligence tips so that you can put your best foot forward in making effective investment decisions in light of today's conditions. And I probably don't have to tell very many people on this call that we are in a very competitive landscape just to get into certain DST programs due to a demand and supply imbalance. So obviously, as Lee mentioned at the beginning of this call, efficient due diligence is key. So first, I would say know the sponsor, their structures, and their strategies beforehand. To reiterate what I discussed earlier, it is of paramount importance to know the experience, track record, and character of the sponsor. Don't wait until a client is in cash or a specific deal PPM is in front of you. Get to know the sponsors out there who are continually making offerings in the market, and review the PPMs and structures of recently offered deals. Because the foundational due diligence on the sponsor's approach really does give you a time advantage because you've already generally vetted the offering structure and strategy. Compare the deal to other programs. For some time in our industry, there's been a growing emphasis on product comparisons as the regulations require wealth advisors to consider reasonably available alternatives to the investment that they ultimately recommend to clients. Now, we've already discussed using customary industry fees as benchmarks, but obviously fees aren't the only things to consider here. Other program and property features such as loan to value, asset class, and income or return profile should be considered and compared to what else may be available in the DST market at the time to ensure that the program is the best fit for your client. Assess how the deal will perform in different market conditions. It's always been important to do this, but especially in today's world, given that we've just experienced, what hopefully will be a once-in-a-lifetime market shock event. We're concerned about the degree of uncertainty surrounding commercial real estate over the short to midterm. You have probable, economic recovery on the horizon, but, so are the effects of the end of significant government assistance for people, potential inflation and interest rates and cap rates that will likely increase at some point. And you also have some property markets where you're just not going to see rent growth for, maybe the next 12 to 18 months as those locations recover. And you maybe know better than I am at predicting where commercial real estate is headed, but you can definitely determine the likely general outcomes for investors under different scenarios in the future. And to be able to do this requires a good understanding of the model and, again, potentially the master lease structure. Understand how the anticipated exit will work. This is becoming a very hot topic. Sponsors are getting more strategic about investment exit and developing various approaches to provide a diversification opportunity on the back end, and I think also to hedge against the potential elimination of Section 1031 by providing a tax-deferred option under Section 721. Forest Springs and other DST sponsors are developing UPREIT structures that will likely be how many of their DST programs go full cycle. These structures are intended to enable investors to essentially convert their DST interests into an investment in an affiliated REIT program, which owns a much larger portfolio of properties. However, not all structures are created the same. They're not all going to behave in the same way in the future. And there are several critical questions you must answer at the outset. First, will the investors have a cash out option, or must their investment be rolled into the REIT? Now, if there isn't an option for the investors to elect what they prefer, you have to ask yourself, is your 1031 client suitable for an investment in a REIT program? If there is an option, what are the mechanics and the time frame for an investor decision? Do they only have 10 days to evaluate the investment opportunity and provide their election, or else be presumed to choose to have their investments rolled up into the REIT? What are the characteristics of the subsequent investment program? What kind of eventual liquidity may it offer? What is its strategy? What has its performance and distribution coverage been? You really need to underwrite the REIT program now as if you are considering it for platform approval. Since essentially that's what you may be doing in placing your client into a DST program with an UPREIT structure. All right, the next tip on how to put your best foot forward for DST due diligence is a bit self-serving, which is to leverage third parties. And, I might be biased, but there are significant benefits to consulting third-party due diligence reports, and really even just calling us up to discuss a DST offering and pick our brains a little bit. You get access to a second set of eyes and professional opinion on the deal. Third-party firms evaluate hundreds of alternative investment offerings like DST programs a year. So we have the perspective on relative strengths and weaknesses, what's customary and what's not in any given deal. Third-party reports can be a source of independent information or resources. For instance, we undertake exhaustive background searches through a third-party vendor that you might not otherwise have access to. And these types of things help save you time and money. And last, it's an industry best practice to consult third-party due diligence and the assessment of risks and mitigants to those risks. And a report can help strengthen your file for a regulatory review. But like I said, it's not, it's more than just the report. We love when people give us a call to ask questions. We take pride in our craft, and it's gratifying to help others advance their businesses with our knowledge. So please use us as a resource. And then last, document that you followed your procedures consistently. Now, there are a lot of elements in that statement. One, that you have written procedures, that you have established them. Two, that you follow them consistently. And three, that you have documented a record that demonstrates you have followed them consistently. Consistently documented files show that you didn't give in to the temptation to cut corners as it relates to due diligence at this time. And that's really going to be the best defense against regulatory and litigation risk. And most importantly, following robust due diligence procedures will help you make the best investment decisions and recommendations for your clients. So with that, I will pause and take a sip of water, Lee, while you see if there are any questions.
All right. Well, thank you so much, Brandon, and we certainly appreciate it. Before we move to the Q&A, we have questions that have come in. A couple of quick things. First, you do have a chance now to put your final questions into the window on the right side of the screen. I'm happy to continue to scan there and make sure we address any that come up. And second, we have Eric Paul, our President of Capital Markets, who is able to dial in Q&A. So Eric, thanks for doing that. And if there's anything that comes up that you see on the Q&A as well, or want to have us address, feel free to do that. Third, I just wanted to ask this, and this is my question, Brandon. We've spent a lot of time talking about the front end of the diligence process, and to that effect, on our end, as a sponsor, we obviously provide high quality, what we think to be very high quality, PPMs and material written by the top firms, strong diligence, third-party reports, and a data room, which is very robust. It includes, everything you would need, and there's never a question that can't be answered. That's really our policy. So the question I have is, what kind of ongoing due diligence do you recommend for firms that they do for DST offerings that they've, approved? What should they continue to do for those types of programs that have been sold on their platform?
Yeah, that's a good question. I think the most obvious thing that comes to mind is to consult the regular investor reporting that the sponsor of the trust provides to investors. That usually there's pretty good extensive reporting on, material events at the property, cash flow, reserve balances, et cetera. And I think sponsors have come a long way in providing that kind of regular transparency to investors as well as advisors. And then I think it just goes back to, how well the sponsor communicates with advisors and their clients. And I think sponsors are, reputable sponsors are always available for questions. And so that's I think how you can avail yourself of the best, most current information. And then also understanding when the program is nearing the end of its life cycle. So if there are, for instance, purchase options that an affiliated REIT has, knowing the timing of those things and being able to kind of prep your clients for starting to think about decisions that they might have to make about the form of their investment going forward. I know obviously sponsors are good at communicating their intentions, or at least they should be, in advance of an exit. But I think those are the things that I would say. And then also last, we look at sponsors. We try to look at sponsors on an annual basis through our operational due diligence on the sponsor itself, and prior performance is a big component of that. So having a regular assessment of just how the sponsors programs are doing generally, we look to see how if they've been meeting their investment objectives, and then especially for full cycle deals, what would have been the ultimate returns to investors.
Great, thanks for that. Some questions that we have in addition, and some of these are kind of granular in a way with regard to what you offer within FactRight as far as information goes. But the first question is with regard to fees and assumptions, underwriting assumptions. The question is, does FactRight have something that would be available, releasable, that could be used, to compare programs as I guess new programs come in? And Trevor, you can correct me if I'm wrong, but I think you're saying as you see new programs, how can you baseline and against any matrix? Is there something that you can offer from FactRight's side, from the third-party side, that would be helpful in comparing?
Yeah, so in every DST report, we lay out what we deem to be the customary or the typical ranges for fees and other metrics, as well as industry medians. We derive these from the database of DST programs that we've reviewed over the past couple of years. There's probably 100 plus programs in that database. And so one is, it's in the report itself. We have in the past put some of that information on our blog.factright.com, so you can find some of that information there. Otherwise, give me a call or give us a call, and we're happy to talk through, what we think is customary in the industry as it relates to these fees and underwriting assumptions, and we're happy to talk through those.
Excellent. Yes, Trevor, please do take him up on that. It's super helpful. Another question, Brandon, is with regarding exit cap rates and the likelihood of returning principal. How do you view loan prepayment and or defeasance that may be part of the loan? Because a lot of these DSTs they're not going to be held until the end of the term. So when we do our modeling, we basically model a sale at the very end of the hold period in order to sort of compare every deal or normalize, I think, the comparisons that we make, because, some programs will have a prepayment penalty up until maybe the last 3 months of the loan period. Other loans are locked out until then, and other loans have more flexibility. So to sort of be able to compare return projections, we basically model at the end of the hold period, which at which point there's really no prepayment or defeasance costs associated with that. I understand that's sort of a synthetic assumption, because in most cases, DST programs are going to have their exit prior to loan maturity. So that kind of opens up another line of inquiry that you have to do when you're reviewing the loan agreement, to see what's the probability that the trust is going to have a significant cost in disposing of the property. Again, those terms can vary from loan to loan. So that, I think, this underscores how carefully you have to review that. But that is a very real thing, and I think it's a good, astute observation to point out that, modeling is somewhat synthetic, and there might be these fees that the trust might need to contend with. Great, thank you, and those are great questions. There's some more like that, and I might encourage, what I'll do is I'll save these. I'm going to actually do a print screen here really fast so that I can pass them along to you, Brendan, because there's some pretty granular and maybe it might be good for you to have conversations with folks that are on the call. One more question that I see, and then Eric, if you're still there, maybe you could share a little bit about the advocacy in the industry, because I'd be remiss if we don't do that before we conclude and let everybody on their way today. Brandon, with regard to what's next, do you guys in the third-party chairs, do you talk about what you think is next for DST programs, changes or advancements that you would either anticipate or like to see from the industry?
Yeah, I think that, a few things come to mind. The UPREIT structure for DST programs, while it's been around for several years for some sponsors, I know, Forest Springs has had that baked into through DST programs for quite a while. I still think it's relatively new, especially for some sponsors. And, the structure I don't think has been tested yet significantly, and I would like to see the industry coalesce around some best structures or features around that. So there's more standardization. One thing that I personally would like to see is optionality for investors to choose to take cash to hopefully pursue a subsequent 1031. Hoping that Section 1031 lasts a long time, or have the option to elect to take operating partnership units in a REIT program if that's if that meets their objectives. So I think there's that. Real quickly, we would love to see a more robust review of financial statements. Most DSTs don't have audited or reviewed financial statements by an independent CPA. I think that would add to the transparency. If we could figure out a way to do that. And then I think also, with interest rates increasing and maybe in the future and cap rates not necessarily following suit right away, I think that investor returns are going to get squeezed a little bit. We've already seen declining yields for several years, and I think investors' expectations need to change a bit, especially with the kind of cap rate compression we're seeing in the really hot asset classes. And then I think sponsors need to share a little bit in that too, and I think we need to see fees come down a little bit as well. So
thank you. No, that's appreciated, and certainly, some of this is trending, and I think will come to the forefront most likely. Well, good. I'm going to take a scan here of these questions to make sure I covered everybody. We've really overstayed our welcome, but we appreciate your attentiveness to the call. Eric, I'm not sure if you're there, but if you would like to, I just wondered if we could just mention the advocacy that's occurring right now since you've been at some of these recent conferences.
Yeah, Lee, I'd be happy to. And first off, thank you, Brandon, so much for your time today. We have an outstanding relationship with the team at FactRight. They hold our feet to the fire, but we are extremely thankful for the service that they provide. I think it's incumbent on all of us in the industry to be promoting the highest levels of due diligence and transparency. As we mentioned, in terms of some of the advocacy efforts that are going on in the industry, I think most people are aware that the 1031 exchange has ended up in the crosshairs of the administration's new tax proposal. I have been involved as our company, with organizations like the IPA to promote advocacy efforts, having the voices heard of folks like ourselves on this call who have a vested financial interest in the ongoing, implementation of 1031 exchanges is really, really important. And it may seem like a small effort, but even things like, participating in some of these email campaigns to your Congress people, or letter writing, or financial donations, as small as an individual donation might be, can make a real big effort in helping to preserve this, what we feel is a really important part of the tax code. And so I'd encourage everyone on the call to take a look at the IPA's website at ipa.com/1031s. They have a huge resource center available, not just educational efforts, but also very specific to the advocacy efforts that I mentioned above. And with a few simple clicks, you can take action and participate in some of those things that I mentioned. And, at this point, I think it's early in the stage, but, the thinking from, experts in the lobbying side of things is that the more voices that can be heard, the better. And so I'd encourage everyone to do that. And Brandon, thank you again for your time. And Lee, thank you for hosting.
Thank you.